Hi, and welcome to the Macro Show. We talk macro, and you wonder, are investors really all in with stocks near their peak? We've got that. We're going to talk about the Chicago Fed National Activity Index. Got a big boost. What does that mean? We got unemployment data, dealer positioning, and of course, what never disappoints, the credit data. I'm Steve Van Metre, your host, and thanks for joining me today. Let's get right into our headline story. And yes, stocks are back near their all-time highs. Let's take a look at the S&P 500 here. We'll focus on the rest of the charts for, of course, our Sunday night chart show. And here you can see right near its all-time highs. It actually broke an intraday new all-time high, but it could not close there. And so, yes, the question is, are investors really crammed into stocks? Oh yes, they are. And let's take a look at this chart here. And what is this? This is the ISM versus discretionary investor equity position. And you can see, the ISM is really an important indicator, even though I think it's being skewed right now due to shipping times and pricing and some other factors in the report that's making the manufacturing sector look a lot better than it actually is. And we're going to take a look at the Kansas City Fed report, find some interesting stuff in that in today's update as well. So what you can see is blue is the ISM manufacturing on the left-hand side, discretionary investor positioning, boom, there you go. All-time highs. And what is, looks like Deutsche Bank predicting, well, they're predicting the ISM is likely to plateau and go lower. Well, when you get pretty much to the highest levels in history, there's generally only one way to go. But does that really support what's going on with investor positioning? Well, it does. This one's from NorthmanTrader.com, and he's got the RIDEX bull and bear ratio in yellow, and when it's down here, this means everyone is bullish on stocks. So the lower it is, the more bullish they are, and you can go back all the way to 2000, 2001, whenever this started, and you'll find out that yes, people are more bullish on stocks now than ever. Of course, we know discretionary positioning says they're loaded in stocks, and yes, that matches. We see stocks sitting near their all-time highs as everybody is all in. And what are people buying for this privilege? Well, usually you buy future earnings, mainly profits, because when you think about it, do earnings really matter that much? I mean, let's take someone who's making $1 million a year. If they're spending $1.1 million that year, that million doesn't matter. If you have someone who makes, say, $50,000 a year and they're only spending 40, the person making 50 has a greater net income. That's important. So, earnings don't matter as much as what your net income is. And check out these corporate profits after tax. So what are investors buying? Well, they're buying the hope that here you can see in blue, the S&P 500, this from Real Investment Advice, and in orange, corporate profits after tax. And what are investors buying? The hope that corporate profits are going to go way up, because the last time we saw this was not the great financial crisis, my friends. It was the dot-com bubble, when people were bidding stock prices up and corporate profits weren't moving. They said back then, I remember I was there in the tech industry, and what did people say? Profits don't matter. Well, they eventually did matter quite a bit more than people thought. And so investors are hoping profits go up. If not, we're in a massive bubble. Let's get into the economic data. I had a request to go over the Canadian Consumer Price Index, and I apologize to my friends up north. I didn't mean to skip it, but I accidentally did in the last episode. So let's take a look at, we have Consumer Price Index in Canada up month over month in March, 0.5% from the previous month. So still, this is flat. Now the experts were predicting 0.6. Now what's interesting is we could be seeing a plateau in the month over month in the Canadian CPI, the year over year double from 1.1 to 2.2. So it looks like the inflation picture in Canada is lagging the U.S. And you'd think they'd be a little bit closer together, but we're seeing them kind of lag a little bit behind. So maybe inflation isn't as bad in Canada. Some of you may be up there are shaking your head saying, no, it's bad. But let's look at core CPI. Now remember, core, you strip out food and energy, unchanged month over month in March to 0.3. And here, this kind of a similar story to the U.S., but obviously not as high, is a core only went up 1.4% on a year-over-year basis from 1.2 the month before, telling us that food and energy prices are really what is pumping the CPIs in the U.S. and in Canada and other parts of the world, with most of it being in the energy sector. All right, let's go on to the Thursday data. and see what we have here of interest. The Chicago Fed National Activity Index. And the Chicago Fed, this is really interesting because a zero print, if you look down here, it should say a zero print pretty much means that it's, there it is, right below. Zero print has been associated with the economy expanding its historical trend rate of growth. Okay, so what did we get? We got a big jump in the index to 1.71, which is normally way off the charts. I mean, again, it says if it prints zero, it's just at its historical trend. Now, remember in the pandemic, right, when the economy shut down, this Chicago Fed index tanked, and then it shot way back up. And what did it get? 4.39, 5.95, and where were we at? 1.71. So we went from the stimulus from December, went through the system real quick. We actually had a recessionary print in February. You might remember that, and it printed at revised now to minus 1.2, which is pretty big. I mean, again, a zero is growth at trend. So a negative number that quick after the stimulus, because remember, people got it in January. So here we are post-stimulus for the second round, or well, I guess it would be technically the third round, second time people got checks this year. We're at 1.71. The only question is how fast does it fade? Because back in January, we got 1.1 print, and on the next month, recessionary minus 1.2. So very interesting there. What we see in the Chicago Fed National Activity Index is pretty much mirroring what we're seeing in the retail sales and other data. How about jobless claims? Let's go over to the Department of Labor report, which I really like better than just what we see there. And initial claims fell to 547,000. Now, this is good. It's good that it's falling. But I do want you to keep in mind, where was this number before this mess started back, the pandemic? It was around 200,000. So if you want to know what the normal churn of unemployment is going to be, around 200,000. Until this number gets to that level where it stabilizes, and we know, okay, how bad is the situation? These double plus that is still bad. Ideally, and I think many of you will agree with me, is if the economy was really booming as much as this factory data is telling us, and people are going back to work, they wouldn't be turning those jobs over very quickly. I mean, you wouldn't expect that. So you would actually expect the unemployment number perhaps to be below 200,000 as employers are desperate to keep employees that are there at any cost. But we're not seeing that. And if we look at the total claims, so you have total unemployment benefits, including all forms of pandemic assistance, they actually went up 491,000, almost 492,000. So still, we're at 17.4 million Americans still on some form of unemployment assistance, and that number is way, way too high. I think if you want to say where is the problem here, well, it's partially the fact that there's 17.4 million people on unemployment, and secondarily, you're seeing people going back to work still losing their jobs. Despite what we'll see when we take a look at the Kansas City Fed report, which kind of makes you think that there's an unemployment problem, but is there? Like, why aren't people going back to work? How about existing home sales? Now, they fell minus 3.7% month over month in March, down, and prior month in February were down 6.3. So existing home sales slowed to 6 million. And the U.S. leading index. Now, this is just another version, kind of, you could say, of the Chicago Fed National Activity Index. And it went to 1.3 from minus, a recessionary, a negative minus 0.1 print in February to 1.3 in March. So again, kind of mirroring what we see there in the Chicago Fed Index. Let's take a look at the Kansas City Manufacturing Index, which went from 23 to 40. So it was a big move in April. And here's the report. So this is kind of interesting stuff here. Let's see. Regional factories reported historic growth and very positive expectations in April. Wow. Compared to pre-pandemic levels, new orders employment have risen for some contracts, but varied by industry. Looking forward, firms remain concerned about the lack of qualified workers. Well, wait a minute. There's 17.4 million people on unemployment. Supply chain constraints, I think that's a big problem, and high material prices. There you go. It's kind of interesting because they do sometimes in these reports include comments from the manufacturing sector, those who do respond to these. It says here, it is very difficult to handle the increased business with supply chain issues across all materials and finding anyone who wants to work. The federal government has incentivized people to stay home and not be productive. Now, that's interesting. Stimulus has and increased unemployment money are wrecking the labor pool. Lower level employees are quitting just to make as much as not working. I don't understand. Can you quit and file for unemployment? I didn't think that's how it worked. I thought, yes, you had to lose your job to quit. I thought to get unemployment. I thought if you quit, you're not eligible for that. So maybe you are under the new system. I don't know. Unemployed workers have no incentive to return to work given COVID bonus payments. Entry-level pay will need to be increased. This will create pressure on other positions. So, you're hearing, hey, we're going to have to increase wages, but those who are above the entry-level position, they're not going to like it. So we're going to have to increase, either potentially increase, or we're going to have, disgruntled employees. We believe the shortage of workers is not an impact from the second stimulus. So that's interesting, as much as a systemic problem of the gig economy. What they're saying is, look, people are finding out they can make more money working from home. Maybe that's true. And simply not enough workers for unskilled and critical positions. We're focused on retention. We're facing significant supply chain problems due to COVID-19 issues, tariff issues, and weather problems in Texas earlier this year. Steel prices need to become stable. Let's see. Largest raw material providers refusing to deliver previously accepted purchase orders at accepted prices, wanting 18% more. Wow. Let's see. We could greatly grow our business if not for steel and labor issues. Supply chains are a mess. Can't get people to apply. We pay upwards of $20 or more per hour with full benefits. And here's one. Liquidity is the biggest issue. Clearly, they're missing out on what quantitative easing is. I'm just kidding about that. Labor shortage driving up prices for most proteins and food manufacturing. So let's look at what we see in the 10th district, because one of the things is you see prices paid. 78% of firms said this is an increase. Now, I did look and see, how much do these regional Fed compare with the ISM, and not as closely as you'd want them to. They're not the best proxy for that. But only 46% of firms received higher prices for their increase in products. So interesting kind of commentary from some of these manufacturers. Looking at Japan from last night, let's see, national CPI went up a massive 0.2% month over month. How about the year over year? Still deflationary, but not as much at minus 0.2. So everyone that says, all we're going to ever see is inflation due to QE, Japan's telling you, not likely. I mean, there's a point where this ends. Preliminary manufacturing, you see the P here, that is preliminary. So it looks like the manufacturing sector in Japan expanded at a slightly faster rate than the prior month. And the services sector was so far expected to be unchanged. We have retail sales coming out of Great Britain shooting higher. I don't know if they had stimulus there. I'm guessing they must have. Or maybe it's, it could be the base effects. But even though the core, excluding food and energy, was up 4.9. So there must be something going on over there. Just kind of looking at the broad preliminary PMI reports, let's just look at the whole Eurozone. And you see manufacturing in April expected to expand at even a faster rate than the prior month, and the services sector is expected to be largely unchanged. And into today's data from the U.S., and let's look at the preliminary PMI from market, looking at an expansion at a faster rate than March, with the manufacturing sector pretty much expanding about the same rate, and the services sector expanding at a slightly faster rate. And that kind of makes sense, because what have we seen here in the U.S.? We've seen some restrictions in states like California get pulled back so businesses could reopen. So you would expect the services PMI to increase. New home sales, wow, look at that, 1.02 million homes, with the month over month a whopping 20.7%. People weren't buying used homes, they're buying new homes. Let's take a look at primary dealer statistics. People look at this and they keep, or you hear people say, well, wait a minute, nobody wants treasuries. Well, you go to the store. Well, who is a store? That's primary dealers. They're the store of treasuries. And T-bills down slightly, 25 to 24 billion. But how about looking at coupons? This is kind of interesting. 2-year and under notes down $1 billion. 2 to 3 year notes went from a negative. Of course, there was a 3-year auction, so now they have 1.6 billion. Still not a lot. We see 3 to 6 year, they're down to 5.2 billion. 6 to 7 year now negative, and 7 to 11 years. Finally, have some little inventory there, 3.3 billion. And how about 11 years? So this would be 20 and 30 year bonds, down about $1 billion to 35.2. So you think, okay, inventory levels aren't that high. I mean, they're just not that high at all. Let's take a look at the credit data. Bank credit actually grew by 53 billion. That's pretty impressive, except when you find out where it grew. Securities in bank credit went up 45.5 billion. So banks are back buying bonds. What are they buying mostly? Well, they're pretty much only buying mortgage back, 36 billion here. Treasuries were down $1 billion, and other securities were up to fill in that gap. How about loans and leases and all bank credit? That they was only up 8 billion. So lending was not up that much. Total real estate loans they're down 5 billion. Consumer loans coming down, down 2 billion. So people are paying off their debt. Look at credit cards down 2 billion. Let's see where auto loans up to, so people are buying cars, up 2 billion, credit cards down 2 billion. Cash assets, maybe we're seeing some of the slowdown in cash growth due to, I don't know if most of the stimulus checks are done or where we're at on that, but only up 24 billion. So there perhaps some indication that we've seen the big boost from the stimulus checks. Let's take a look at the year-over-year rate of growth on this. Real estate loan year-over-year almost minus 1%. Here you see it's contracting. Last time, you look at contractions and you see red is 30-year treasury yields. What happens? You can see yields going up in credit contracting. Then what happens? Yields go down. And here you can see yields going up, credit starts to contract, boom, yields go down. So the notion that yields can only go up, when you see a credit contraction, it tells you they're too high. How about commercial industrial loan growth? Down almost 11% from a year ago. Look at that, boom. Although the 3-month rate of change is saying that, hey, look, this thing is perhaps stabilizing. But you talk again, this is money destruction from a year ago. It's down almost 11% from a year ago. And total, looking at all loans and leases and bank credit, there's the total money growth in commercial banks being destroyed, minus 3.8% from a year ago. But we're seeing some stabilization at, the 3-month rate is pretty much flat, and the 6-month rate of change is only down 1%. And so there you go. There's our Friday show. We'll be back on Sunday, of course, for the Sunday night chart show. Looking forward to that. And we'll be back on Monday, of course, for the macro show. Really appreciate all of you being fans and watching, and I will look forward to seeing you on Sunday and then back on Monday. Bye now. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. It shows not to be construed as a recommendation or solicitation by outstanding security, transfer, instrument, or participate in particular trading strategies. Video was prepared by Steven Van Metre, reports to Passy. Business expressed this video that do not affect the view of Atlas Financial Advice Inc. or Steven Van Metre Financial.